talk about EMs, it can't really be a broad brush approach, and I think that's what we've seen so far. Sentiment seems to be pretty good, given the dovish Fed. Fundamentals in place as well?
Slowly, fundamentals coming back in place, but I think, Haslinda, it's worth going back to how we got here with emerging markets over the last 12 months. If you think about the backdrop at the end of 2018, it was very different. There's a lot of negative rhetoric around trade wars. There was a lot of fears about the Fed continuing to increase interest rates. The dollar was stronger, the oil price was high, and we saw fears that there would be a slowdown as a result of the high interest rates. What we've seen over the last few months is a reversal of some of those trends and a stabilization elsewhere. So if you think about the Fed, we've seen a reversal of their positioning. Now they're going to be a lot more supportive in terms of monetary policy. We've seen the dollar stabilize. We've seen the oil price look to also stabilize. And most importantly, we're seeing what looks to be finally a resolution of the trade war between the US and China. And when you put that all together, coming back to your question about fundamentals, we do see a recovery in places like China. We do see a recovery in places like India with capex improving. We think Brazil is looking more interesting. So the fundamentals are looking a lot better alongside that more positive backdrop.
How convincing is the recovery in the Chinese economy? We had Jin Likun of AIIB, whom we'll be hearing from slightly later. He says he's not too concerned. China is in a comfortable position. He's looking at 6+% GDP. Do you share that sentiment?
I think it'd be better than that. I think 6+ is very conservative. I think the most important thing to think about China is where we've come from and where we are right now. So China is a big economy. There's a lot of change. There's a lot of flux going on in China. But when you think about the reforms that are happening, these are not reforms that just started taking place in the face of the trade war. These are reforms that started 3 years ago when you looked at much more aggressive tightening of shadow banking, when you saw supply side reform in manufacturing and industrials, and then the trade war helped focus the minds of policymakers, focus the minds of corporate leaders. And what you've seen now in the more recent past is tax cuts, other fiscal liberalization. So the overall economy is a much more balanced place. And when you look at the breakdown of the economy between the external side and the domestic side, it's much more balanced. So 10 years ago, 15 years ago, 2/3 of the economy was trade. Now that's less than a third. So it's much more a domestic-oriented economy that we think makes it a lot more sustainable for the long term.
Manraj, it's Yvonne in Hong Kong. So should we expect that policy can stay where it is, where people are calling it bazooka stimulus or whatnot, but given that the economy is looking a little bit more firm, that they're going to make some tweaks in the policy, therefore that could actually dampen this rally we've seen in China?
I think you'll have to watch the central bank very carefully. We've already seen reserve ratio requirements being reduced. We've seen administrative measures being relaxed as well. You've also seen the tax cuts come through. So the government's going about it in a very calibrated way, and that gives it legs over a period of time. I don't think you're going to see a sharp pullback in terms of that policy relaxation, because we're yet to see the full impact of what happened at the end of last year with the trade war take root, and the government's going to be watching that very closely. But when we talk to companies on the ground, we see a much more positive sentiment on policy, and most importantly, don't forget, the government needs the rural areas, the second-tier cities, the third-tier cities to continue growing, to keep the electorate relatively positive in terms of sentiment. So they're going to make sure the policy environment is supportive for that.
Yeah, we're talking about the turn in the data in China. I guess you could say that to a certain extent when it comes to Europe. We saw the German manufacturing numbers last week look a little bit less bad here. Is it still too early now to talk about the potential rotation out of EM into markets like Europe, now that growth is looking a little bit less vulnerable?
Well, I think EM has a long way to go. As I said, when you think about the relaxation in China, when you look at the elections we're seeing in India, that looks to remove one of the major uncertainties for EM. when you look at what's happening in Brazil in terms of reform, it's been a while since the breadth of EM opportunity is as wide as we've seen. Valuations are still attractive. As I mentioned before, the backdrop in terms of policy and stimulus is very positive. The U.S. is going through a bit of a recalibration in terms of growth. And to your point on Europe, parts of Europe will do okay on the back of what's happening in the emerging world. But I think the bulk of Europe is still getting very inward-looking. Growth is slow. You've seen monetary policy continue to be accommodative and quantitative easing persisting. So I don't think the macroeconomy in Europe is going to run away anytime soon, which means attention will have to focus on where we see positive secular trends, and that points us towards the emerging markets.
Now, speaking of emerging markets, you like China. Apart from China, what else? Which other EMs are looking pretty attractive? We saw how Turkey, Argentina, Pakistan weighing on the other EMs last year.
Yeah, well, it's interesting when you look at those crises, which got a lot of attention, places like Argentina, Pakistan, Turkey. If you put them all together, those three economies probably constitute maybe 1.5% of the emerging markets index. So if you put together the top 20 companies in the emerging markets, those 20 companies are much bigger than any of those countries put together. So those crises got a big share of mind, but they really didn't move the needle. Now those stories are behind us, and people are focusing on the bigger economies, the more sustainable ones. Some of those we talked about already, like China, like India, potentially Brazil as well.
And Manraj, real quickly, just want to check your calls when it comes to oil. I mean, we're seeing Brent crude, WTI up some 2% here at the moment. At what point does this become a risk to some of these current account deficit countries?
We saw that last year where stronger Brent was not good news for India and Indonesia. I think as long as crude stays around these levels, we should be okay. The overall picture in places like Indonesia and India, in terms of the economy, is more stronger, more balanced than it was last year. You also don't have an environment where Fed funds was going up and capital was coming out of those countries. So there's a lot more liquidity able to soak up that tightness. So I think as long as we don't get a sharp reversal or indeed political risk bringing about a higher risk premium in oil, this should be manageable for most EMs.